Cashflow hackers, it's Chris with Life180. I am here with my friends today. We are doing a talk. Jeff says he's backstage, y'all. I'm going to bring him forward. We're going to do a talk today about what's going on in the economy here in 2024. We're going to talk about what kind of we're talking to our clients about, how we're coaching people depending on what your financial situation is. Maybe some things you can do in 2024 to set yourself up for financial success. I know there's a lot of uncertainty in the economy right now. A lot of people are questioning what is the best thing to do. Maybe you are dealing with debt issues. Maybe you're dealing with the fact that you're sitting on capital. Maybe you sold an asset because you are deciding to sell high as the market has kind of been on this crazy run that makes sense to very few people. And you're sitting on cash and you're wondering, what do you do with that cash to prepare and move forward and all these different things. And if you know and you watch the channel, you know that we focus more on financial structure than any one financial product. And when you focus on financial structure and you kind of reverse engineer the process, yeah, we need to use products in different ways to kind of help us accomplish our goals and objectives. But it is about structure more than anything else. So without further ado, let me introduce all my friends. And it says, Jeff, brother. So I got Jeff Kamke on here, but it says that, he doesn't have a camera. So I'm going to remove him. Jeff, message me when your camera's working. And we'll go from there. But I got Michael, Matt, and Charles with me. They are all agents with the Life180 team. They all run their own organizations. Is how we do things. Everybody that joins Life180 is completely independent. They run their own organizations, but we're all on the same mission to educate people about their personal finances and help people regain control of their financial life. And everybody's got their own way of doing things. Everybody's got their own way of doing things. And ultimately, that's what I thought would be really fun on this video today to talk about, is kind of give everybody an opportunity to kind of share what their perspective is in the economy, in the world, and what they're coaching people to do about their personal finances and how to prepare. So without further ado, and by the way, we'll have some chats. Hey Juan, what's going on, man? So without further ado, let's get into it. I'm going to start with, I feel like I always start with Michael, so I'm going to start with Charles today. So Charles, what's up, man?
What's going on, Chris? What's going on, everybody?
Yeah, man. You and I have a lot of really fun conversations.
Absolutely.
Regarding all this stuff and the economy and, just personal finance and investing in real estate. And, we've talked a lot about what I got going on in the Dominican Republic, what you got going on. You've invested, in real estate in Alabama and different things like that. But you have a unique job in the sense that, you're licensed, you're passionate about this stuff, and you joined us and you kind of do this. I'd say you do this part-time because you got a full-time job, but you kind of do two full-time things is the way I look at it, because you're a beast, and I love it. But that said, you're in a unique position because you earn a good income and you have contemporaries that you're kind of surrounded by all the time. And I know you have a passion for helping other people that you work with and that are kind of in your same position learn what you've learned. And so I would love to kind of hear your perspective on why you're doing what you're doing, what you think about 2024, what you're talking to people about, and kind of go from there.
So first and foremost, I think conventional wisdom around finances is upside down. It's like an upside down pyramid where the point is teeter-tottering. So a lot of people just want to throw money into the 401k and high risk financial vessels. But what I've come to realize is that if you want to build a structure, if you want to build an empire, you want to have that strong foundation first. And so what I've found over all the research that I've put into whole life is that it's the perfect foundation for your finances. I'm not saying that it's the end all be all, but it's definitely just an amazing foundation to branch off of. So I definitely like to educate clients and let them know, like, hey, this is where your money's at right now. But I've been working on creating these assessments that allow people to take them, and it identifies what the persona is. And then we can ask each other, say, hey, are you actually putting your money with where your money is in alignment with your values and beliefs? And a lot of times that's a big fat no. So then I'm able to educate them, and they're able to educate themselves, and then start aligning themselves with where their money's at. But looking at 2024 and where we're at, like you said, there's so much uncertainty out in the marketplace right now. People are just kind of sitting on the sidelines. They don't know what to do. You know, the market just keeps going up, and there's a lot of talk of a recession in the future. However, we haven't seen that yet. So there's just a lot of uncertainty, and people aren't aware of safe products to put their money into, and Whole Life absolutely achieves that. You know, 2024 is actually one of the best years to put money into your whole life policy. And this goes back, like, for the past 80 years, 2024 and what we're looking at right now, like, this is the best time to actually put money in your whole life policies. And the reason I say that is because we've had, interest rates have just been dropping for the past 40 years, right? And that's not the best environment for whole life. But now that we have an uptick in interest rates, we don't know if they're going to continue to go up, if they're going to level off, or they're going to go back down. But what it does is it just amplifies the general funds of the whole life accounts. So we're going to have strong dividends in the future because of the way those general funds are structured. So overall, 2024, I see a lot of challenges, but this is also just a perfect time to put your money into a vessel where you can have access to it to springboard and invest when deals come up, because I'm pretty sure that deals will be coming up this year and then into 2025 and then possibly into 2026. So be prepared, have your money on standby, and be ready to deploy it to make big moves for sure.
I love it. So I talk to people about that all the time, right? Like, I think it's important to have dry powder in at your disposal for when economic cycles happen. I think one of the things that we all talk about, and one of the things we all believe in, and that's why we're all working together, is the cyclical nature of the economy. And 2024 is interesting because, I mean, it's an election year. I think a lot of the indications, technicals would show that the economy makes no sense, but that's a pretty normal thing when it comes to the economy making no sense during an election year. It's these politicians, I think a lot of times, are underestimated in their ability to manipulate things, and the way policy is done and the way money is printed and the way that information gets out there to people and, the reality. But at some point in time, we hit a breaking point, right? And things have to correct. And the new, way things are happening and the way that we've had the monetary policy since COVID, and the bottom line is, I guess where I'm going with this is the cyclical nature of the economy is not going to change based on the fact that we're just manipulating and printing all this money and doing all this stuff. Eventually, it always gives, and it should have given back at the beginning of COVID, but because of the fact they gave so much money, and the market did crash, by the way, right? It went down almost 60%. And so, when we look at that, it's Jeff, it works. So the market went down over 50%. And so then they just printed money. They gave all these deferrals on mortgages and made it so people didn't have to pay their bills. And they did all these different things to kind of kick the can down the road. They injected a lot of money. They printed money. They gave free money away, all this stimulus money. And to me, all that did was made the bubble bigger. And if you look at the fundamentals and the earnings per share of stocks, of companies, and like all the things, they're all at like the worst levels that we've ever seen. Debt levels right now are at the worst levels that we've ever seen. National debt, consumer debt, everything could not be worse, or has never been worse than it is right now. So in what world does it make sense that the economy is going to keep going this way? And the only answer I can come up with right now is that it's an election year, and that they're just kicking the can down the road. And so I want to hear you, and this is something I want everybody everybody else on the panel. I want to get your take on this as well, because this is going to be an important one. Because I'm a big believer that a whole life policy is a great place to keep your emergency fund. I know you all are too. A lot of people will give me kickback and say whole life insurance, like the Dave Ramsey fans of the world, right? Will give kickback and say whole life insurance is a horrible place to keep an emergency fund, because why would you keep your emergency fund in an account that you're required to pay? Right? Like that you have an obligation to every single year. And a lot of people misunderstand the flexibility. They misunderstand a lot of elements of whole life insurance. And so I'd be curious to hear like what your response would be to people that say that.
Yeah, so when somebody says that, whole life isn't flexible, I would say that's very true if it's a traditionally designed policy. The policies that we specialize in are built for maximum flexibility, because what we want to do is think of the long term. We don't know, what 10 years down the line is going to look like. So we want to engineer that flexibility so we can keep our policies for our entire lifetime. But the reason that you would want to have your money in an emergency fund such as whole life, or use your whole life as an emergency fund, is because you would understand the value of that uninterrupted compound interest that you have with your whole life policy that you don't necessarily have with other vessels. So, weighing those two different options, and I'm not saying put all of your money in whole life as an emergency fund, but it's definitely another vessel to leverage and utilize just to enhance your finances as a whole. It's an important part of the whole financial picture.
Yeah, for sure, man, for sure. So, well, thanks, brother. I'm going to. Who wants to go next? I'm going to bring Matt on. Matt. Let's bring that Matt on and have him.
What's up, man? Guys?
So you've been hearing what? I'm good. What's your take on all this? I know you are pretty opinionated on these matters.
Proud of it too. When it comes to this stuff, anyways.
Yeah.
So I think 2024 is going to be a year of chaos.
Mm-hmm.
There is just an incredible amount of uncertainty. We got markets at all-time highs, debt at all-time highs. It's like nothing makes sense anymore. And for me personally, I like to have more certainty than chaos in my life, which is why I love dividend paying whole life insurance. I'm so grateful that I came across your channel, Chris, and it sent me down the rabbit hole, just learning how these things work and just how powerful they are. How many problems just this one product solves in our life. It's just so efficient. There's a reason they call it the financial Swiss Army knife, because it does so many things for us. But in a world of so much just uncertainty and chaos, what can we do to start to eliminate some of that? Another big thing for me is I do not trust the banking system at all. We're taught that, or sometimes we just assume that the safest place to put our money is the bank, to save it for opportunities, emergencies, etc. But when you think about it logically and you just look at history, banks are like the worst place to keep large amounts of capital. I'm not saying I don't have any money in the bank. I do. But I've actually moved most of my large, like safe money, my actual capital for emergencies and opportunities, I've moved it all into dividend paying whole life insurance. Again, I still have some money in the bank. I'm not saying not to put all your money in there, but
you're not paying all your bills. You're not paying all your bills through your whole life policy.
Correct. But like because I'm sitting on the sidelines with you guys were mentioning talking about the dry powder earlier, which you absolutely want to do. But instead of having that dry powder just sit in the banking system, which for me is very risky, plus it's not doing anything for you, why not put it into one of the most efficient financial vehicles in the world, dividend paying whole life insurance? Because when those opportunities present themselves or an emergency comes up, I can always borrow against the policy and take advantage of those opportunities or take care of the emergency fund. Plus, I have the death benefit in case something happens to me, have living benefits in case something happens to me. You get all these benefits from one financial product, not to mention going back to the uncertainty and chaos that's going on. Nobody knows what's going to happen. Nobody knows which banks are going to fail. We're going to see more bank failures. And I don't know about you guys, but I sleep a lot better at night knowing that my safe money, my working capital, my business capital, and all that is with the safest companies on the planet that have weathered every financial storm throughout history. And while all the banks were failing, and during the Great Depression, the financial crisis, savings and loan crisis, I mean, you name it, these companies were paying dividends while the banks were failing. So for me, because I just funded my second policy, and I sleep so much better at night knowing that it is with the best risk management companies in the world. It's going to get that safe, tax-free compound growth. I have access to the money when the opportunities present themselves. It's just a no-brainer to me. Like, once you understand how these things work, if you're trying to insulate yourself from the chaos that is taking place and is going to take place, I just don't see a better place to store your money there. So
I mean, it's really interesting. It's really interesting. The economy, the value of the dollar, like all these things that a lot of people talk about. I think it's one of those things that's a lot of times misunderstood. Brian, who we disagree with a lot, but I think when it comes to the economy, we probably see things very, very similarly, right? We just believe the solution is different. That said, one of the interesting parts of the economy is a lot of times people don't realize there is a difference between a strong dollar and a weak economy. A lot of people think that when the economy struggles, the dollar is going to struggle. But actually, because the U.S. is the world's reserve currency, there's a history of showing the dollar gets stronger in economic crisis, because when we suffer, so does the rest of the world. And because we live in this fiat currency system, the whole idea of the gold standard and all this stuff is a bunch of bullcrap. Like it's not really in place in the world anymore. And so therefore the value of the US dollar is only valuable in relation to the rest of the world. Right. And so for instance, I'm living in the Dominican Republic right now. Right. And when I got here, it was 54 Dominican pesos for every dollar. Now it's 59 Dominican pesos, right?
That's crazy.
So that means the dollar's getting stronger and the peso's getting weaker. I follow the Colombian peso, I follow the euro, I follow all these currencies, and no matter what's happening, it makes no sense, but the dollar is getting stronger right now. And if you go back to 2008 when the economy crashed, the dollar got stronger and stronger and stronger. When the rest of the world suffered, the price of gold went down, the stock market went down, real estate got thrashed, all these things. The best performing asset in the world in 2008 was the US dollar. Think about that. It makes no sense either. Why? It's all if you really break it down, in a vacuum, in a bubble, it would make no sense for that to be the case. But because of the fact that we're only comparing the value of the US dollar to other currencies and to other assets, and everything goes down in value. So if there's any stability and at all, and I know, our debt is crazy high, but inflation was high. Back then it was all the same conversation. Everything's a little bigger now. But I don't think the principles are going to change. And so I do believe we're in line, or, we're kind of waiting for an economic correction. I think asset prices are going to get hurt. I think, policy is going to change, but I am not one of those people that believes the dollar is going to go away.
Right. No, for sure. And you know what's interesting about all that, Chris? It's all the more reason to trust the best risk management companies in the world, because everything that we're discussing, like you said, it makes no sense why the dollar would be a flight to safety. It's trash. It's complete trash, but it is, and it makes no sense. But instead of me trying to understand all of that, I'd rather give my money to a company that has been managing chaos like this for 146 years. Just let them do it, totally. And just be informed and so you take advantage of opportunities and stuff. But I could never sometimes I think I know, all right, I finally got a grasp on all this stuff. And then the stock market hits all-time highs now. Totally. With interest rates high, stock market's at an all-time high. Just nothing makes sense. So you know what? I'm going to let the life insurance company deal with that. Just manage your general funds. You guys know how to do all that stuff. I'm not messing with it. So
Yep.
it's all the more reason to consider something like a
Yeah.
mutually owned life insurance company for large amounts of capital.
Yep, for sure. No, I couldn't agree more. And Brian just made the comment, that inflation is healthy for an economy. Stagflation is a hazard. I would argue, yeah. I mean, stagflation is always bad. If anybody doesn't know what stagflation is, it's basically when inflation is going up, but incomes, wages are not going up at the same rate of inflation. They're not keeping up with the pace of inflation. I would argue that the reason for inflation is really the danger, right? Like if for instance, I don't think inflation inherently is bad. Because inflation can happen for the right reasons. Inflation can happen because of an expansion of the population base, an expansion of productive output, an expansion of, just growth in an area. Maybe a technology comes in and allows for inflationary terms like AI. A lot of people, I think AI could actually be one of the best things for the economy right now, not because it's inflationary, but because it's actually deflationary.
Right.
And I think it could actually cause a lot of stresses on the economy right now. So I think that's one of the things, I actually did a video on that a couple months ago. And so like, I would just say like inflation, it's not good or bad. It's just like, what is it really caused from? Right.
Well,
so,
I would push back on inflation is healthy for an economy. I don't understand. I don't really get that, because inflation is theft. Now, if you're talking about price fluctuation due to natural market cycles, well, that's going to happen. But inflation is literally stealing your money. And
no, I mean, inflation can happen genuinely if we allow a free market to cause inflation and deflation and allow it to go with the natural cycle of things. Target inflation and market manipulation with fiat currency policy, that's the danger.
Right.
Totally. All right, I got all you other guys here, and I want everybody's take on this topic because I know it's a juicy one, so it's fun. So, Michael, what do you think? You're muted.
My bad. No, I kind of just look at things and, I see a lot of issues, and I don't know that I look at the dollar and I'm like, it scares me, right? You see the inflation and you see that the home prices going up and you see all this stuff, stock market's up. And, I think it leads people to think that there's going to be a big crash at some point. And I think there will be some kind of crash, but my worry is that crash won't be as big as people think, because it's really just, that's what the dollar has come to, right? It's not that the market or, things are gaining value. It's that the dollar is losing value. Right. And so when you look at all the printed money over the last few years, basically since COVID, I don't know. I think
that's true.
There's not going to be as big of a crash as people think. I think it's just the new price of the dollar, and that's kind of my opinion on it.
Yeah, it is kind of crazy. People I think lose sight of that a lot of times. If inflation is 8% and the market does 10% as a return, while your nominal real return is really only 2%, right? Because that 8% really goes up the first 8% goes to make up for the loss of purchasing power, the loss of value of the dollar, right? Yep. And so and that's the thing, like a lot of I know I said I wouldn't do this, but I'm doing it. A lot of these IULs, they have these no risk rates built into everything, which is basically like the 10-year treasury note, right? And it's like, say 4.5% to 5.5%, depending on the treasury note at the time, where that's going to come off the top no matter what. The market has to do at least that in any of these non-capped indexes, before you get anything back. And so from a long-term strategy, it's pretty dangerous. You're playing with fire. It's definitely not a buy and hold kind of product. And that's the, main difference to understand between whole life and IUL in that spend. Now, I don't want to go too far down that rabbit hole, but I just think it's like understanding, those metrics, and those moving pieces to everything, understanding the fact that there is that no risk rate in there, and that it's called that for a reason. You know what I mean? Because the insurance company has to take into account the risk of inflation on the general fund from a long-term perspective, and they are able to kind of manage that based on the 10-year treasury notes. And so that's that. So We got Ian joining us now too. This is pretty fun. So, rock and roll. Matt Seibert, what do you think, bro?
I don't want to get political, but I think you'd have to be living under a rock if you don't understand. If you don't understand that our country, I don't know who's running it, but it's certainly not the people that should be running it. Ever since COVID, you saw our country getting takeover. I don't care if you call it the elites or whatever the case may be, but it's very clear that we have no control of our country, mismanage of our tax dollars, putting us in debt, printing money. All these people in power, these politicians, are using money for not the best interest of our country. And when you look at what's going on, there's just it's just a wild, wild west, right? And all I could think about is your married family or your just average family that all they're thinking about is just paying the bills, right? Go to work, get some money, pay the bills, live their life. And they don't even know what's going on because they just don't really dive into it. Unfortunately, I've been cursed because I can't stop diving into it and see what the hell's going on. But I think when in a world where there's so much chaos, uncertainty, lack of, we don't know what's going to happen, I think Whole Life really fulfills at least a place in people's life to provide certainty, provide control, predictability, more like a safety net, right? I think everybody believes that we should have some type of safety net after COVID and after everything that happened. Not only should you have life insurance, I think that woke a lot of people up, but you should also have your money, a portion of it. They say diversify, right? Don't put all your eggs in one basket. Everybody understands that terminology, but yet when you look at where everybody puts their money, it's not diversified. Most people have all their money in a 401k, all their money into the market, all their money wherever, of all of these financial vehicles without a long-term proven record, and really actually a poor proven record of being able to keep people in a safe place and all their money without losing it and stuff like that. And so when you look at Whole Life, I think everybody should learn about it. They should put their money into it. I truly believe in it because it has a proven track record for hundreds of years. Like what Matt was saying, they're like the best at managing risk. And when you look at what's going on in the country, I think you can't control what's going to happen in the government. You can't control what happens with the dollar, but what you can control is where you decide to put your money. And I think when you look at all the possibilities, to me, talking with tons of families, a lot of people over the last decade, without question, everybody believes a percentage of their money should be in the safe bucket, a place where there's control. They don't have to worry about losing it. They know that's like the safest place they could put their money. And then a percentage in the risk bucket where they may be willing to risk it. They understand there's risk involved, right? But I think if you look across, the board, our country, they're lopsided. Most of them are in the risk bucket, IULs, 401ks, all this stuff, right? And then hardly anybody has anything in the safe bucket. And I think it's totally backwards. So with all the uncertainty, I think March 11th, the Fed is going to end the emergency lending program. That emergency lending program is what was slowing down the banks going under, all these regional banks. So that ends March 11th. So that's going to be the kickoff. I don't know what's going to happen, but I do know the banks really relied on it. And if they don't renew that, I think that might trigger the whole economic collapse. We'll see what happens, but a lot of uncertainty. Everything is speculative. We don't know exactly what's going to happen, but I just know this. I think people should have a percentage of their money where they know it's safe, that no matter what happens, it's going to be there when they need it. And Whole Life fulfills that for everybody.
I love it. March 11th is right around the corner, bro.
Yeah, that's this week.
It's coming up.
Monday, yeah.
We should do a special edition on that day. That'll be fun.
Mm-hmm.
That's cool. Camkey, can you hear me?
I can. Sorry, the private chat popped up right when I was going on mute.
Yeah,
I think for me, this discussion really comes down to some of what Matt was talking about. There's so much uncertainty in the world. We don't trust our government. I think that's been, so many people have had their eyes woken from the last 4 years of how things have been handled. There's a lessening of trust with what's going on and how we're handling things at large, right? From the economy to money to inflation, all this stuff. And just as we see out there, there's obviously a controlling elite that are doing things to disempower most of us. And they don't want us empowered financially. They don't want us empowered when it comes to healthcare. They don't want us empowered across the board. So more people are waking up to this realism, and it can really stir up a lot of emotions in people. And so for me, Whole Life comes in as how do we take responsibility for our own life? The government's not there to bail us out. They're not there to protect us. They're not there to put our needs first, right? It's the other way around. So we have to wake up to the fact that this is where we're at, and we have to put our big people pants on, our grown-up pants on, and realize if we want something to change in our personal finances, we have to take control of that. And so for me, whole life fits the bill of this is something we can do to take back control over a portion of our money so that we know what it's doing. We have predictable results. It builds a solid foundation to do other things with, whether that's speculative investing or however we want to put our money to work. It's efficient. So it's really control and efficiency for me. So efficiency is meaning, hey, we can put money into a policy. It's flexible throughout our lifetime. It serves multiple purposes. It amplifies many things we're doing with our money. And, you know, another thing that I've observed in the last several years being in this industry is, in not just finance, but in all areas of life, we tend to be very singular focused. We don't see big picture a lot of times. And so if you listen to those, like, you know, the gurus like Dave Ramsey, they tend to get us thinking very isolated, you know, looking at our money in very isolated ways. Like, okay, well, these dollars are going to buy term life insurance. So it's checking off a box. And then, okay, we've got another bucket over here that's for our longer term for retirement, right? And we don't ever think about is there a more efficient way to accomplish both check boxes of life insurance and retirement, for instance, in a more efficient way, right? We get our dollars going further, doing more efficient things. So for me, whole life fits that bill because it gives us both of those aspects. Efficiency makes our dollars go further, which gives us more money to put back into our living and lifestyle, to growing our money for the long term, right? To be able to put money to work. If we're more efficient with the dollars flowing through our hands, we've got more to maybe pay off debt or put that money to work. So that's a huge piece. And then just that control piece, just what that does for our money, what it does for our psyche. That's so important in today's world where there's so much uncertainty and like emotional volatility because we see all around us all this chaos. And if we can start doing things that brings more certainty to our lives and our financial lives, that can have an effect positively on our health and our relationships. If we just know that, hey, we've got a stronger bedrock in our personal finances, maybe there's less arguments with our spouse. Maybe our blood pressure is a little bit lower. So for me, control and efficiency, whole life is where it's at to be able to really up level all areas of our life.
I love it, man. That's well said. Well said. I love that. Who do I got here? All right, Ian, let's have you chime in. You joined a little bit late, but, you know, we'll still give you some airtime.
Yeah, I appreciate that. And yeah, it's been, you know, I just caught the last little bit of Matt's discussion and what Jeff was saying, and I completely agree, especially with what Matt was saying in regards to the fact that, you know, if you ask people, most people believe that they should have at least a portion of their money in safe, reliable funds or in a safe place. Yeah. And thinking at it coming from my perspective, getting into the financial game and this kind of area a little bit later on in life, I spent the majority of my life thinking that a 401k was safe, that it was savings, and thinking that a lot of what I see now is and understand is very risky places to put money. I used to think those places were safe. And I think it's just, you know, part of our lack of financial education or the conventional wisdom to just do these things because everybody else are doing it, or because our parents did it and it worked or kind of worked, or because somebody like Dave Ramsey says that's what we should do. Before, you know, we do all these things without really having I speak for myself and what I've observed in conversing with people and talking with folks is that there's the idea of having money in a safe place is what people are wanting, but the reality of their situation is not that in a lot of cases. And like what Jeff said, whole life, it's reliable, it's consistent. It's got a lot of these companies, they've got 150, 180 years worth of doing the same thing consistently and reliably, and producing results that people can use to know what they're going to have in the future, rather than a speculation or just hoping that they have something. Whole life provides a vehicle where people can actually plan with their future.
Well, right. No, and that's what I started off this video talking about, financial structure, and the fact that we're all focused on financial structure. And I think when we reverse engineer the concept of financial structure being important and having that safe, liquid, guaranteed, accessible capital as the base of the foundation of financial structure, and we talk about the first need is getting an emergency fund built, right? Like, I think a lot of times people think of an emergency fund and they go, oh, what do I need? Well, the emergency fund, like according to Dave Ramsey, is just 6 months of income just in case you lose your job. To me, an emergency fund should encompass infinitely more than just in case you lose your job, because you're likely, what happens if you get into a car accident? What happens if you suffer a traumatic brain injury? What happens if you get cancer? What happens, like all these things that I've been personally impacted by with my wife, my father-in-law, and seeing all these people like, experience firsthand, and you realize like, whoa, an emergency fund needs to be way more than just 6 months of income in case I lose my job, to help me bridge the gap until my next employment opportunity, right? Like, and so, I think when we look at that, and we look at the living benefits of whole life insurance, when we look at the guarantees, when we look at the savings alternative, right? Like it's not a bank account, but it is a banking alternative that's got a lot more of a history of success in financial structure and predictable growth. Like guarantees and dividends that have paid out every single year for 180 years for a lot of these companies or more, and it just you look at it like that, and it makes all the sense in the world. And Wealth Wisdom, Gilbert here, was like, no, it's not Gilbert. Talked about the fact that they call 529 plans savings accounts when they're really just investment accounts, right? Like, the words that we use are really, really important when it comes to money, but there's and don't think it's by accident that they call it, educational savings plans. No, they're investment plans. And the difference between investing and saving is just a function of risk, right? And I think the danger with 529 accounts is the fact that when you have an 18-year window at best to be able to invest money, the sequence of return risk is amplified dramatically, right? Like with that shorter time window compared to a retirement account. They talk to you about, you need to save for retirement. Nobody saves for retirement. Everybody invests for retirement, period, right? Nobody's saving for retirement. You're investing for retirement. But the bottom line is, if you were to talk to everybody, as you said, Ian, everybody, if I were to ask them, hey, do you believe you need an emergency fund? Almost everybody is going to say, yes, I believe I need that, because I think it's just kind of good adulting, right? Like most people, like if you ask them, like I think people would not, unless they're really unique, would not openly admit, no, I don't need an emergency fund, right? Like most people would say yes. But when you ask people how much they do need, most people will say 3 to 6 months, 6 months most of the time, because that's just the way people are programmed through the media. And they don't have an answer as to why. They just are regurgitating information that they've heard or read or like whatever through an article here or there. And so when you ask them about like, all right, how much do you need? They tell you that, and then you ask them how much they have, and it's nowhere near what they think they should have. And the problem is, it's because they're focused so much on giving up control of their money, putting money into the 401ks, and putting their money in a place that's not in alignment with their values and beliefs. And then what they just told you that they believe they should do, they're not freaking doing.
Yeah.
Right?
Yeah, Chris.
Go ahead.
Chris, I learned this the hard way. I luckily for me, I did get into a pretty decent job fairly young. So I was actually able to buy my first property at 24.
Nice.
But I fell into this trap too, right? I was at a Fortune 500 company, set up my 401k. And so all my money I had no control over, right? I had no access to it. And so I look back at that property, right? I'm 40 years old today, and I was paying extra on the mortgage, and I ended up selling that property, went through some things in life. But a big reason why I sold that property was I didn't have access to my money, right? Like I didn't have control. And so, like how valuable is that control, right? That's the conversation I have with people, because, there's a lot of people that sell life insurance as retirement or things that it's not, right? But it is a savings. It's a place to save your money. I think you hit on a big point too. It's insurance, and that insurance piece is pretty important when you have the the living benefits and you have the death benefit for your family on top of the control of your money, it's just to me, it's a no-brainer. I consider it a foundational piece to everything I'm building, right? And so if you can start with the foundation, I can go build a retirement portfolio. I can go invest in hard assets. I can go get my real estate. Like I'll tell you what, I always knew real estate was important, and it was one of the best investments you're ever going to find. I believe that 100 times more so now, right? Sure. You know, actually after seeing, okay, I sold that place. I mean, I could be cash flowing $3,100 a month from that property. I could have taken that equity and gone and invested in another property already. So my biggest regret is selling that property. My second biggest regret is putting my money in the 401k. And don't get me wrong, because I know there's a lot of agents out there that will try to scare you into not putting money in the 401k by telling you how risky it is. My 401k performed well because I started around 2005. So when we hit that drop, I didn't have much money in there anyway, right? So I lost a couple grand, and then the rest of my ride was all a bull market. So my 401k performed fairly well, but the reason up until I left my job, but the reason I regret it is because I ended up making decisions like selling my home based on what I had access to. And so it was more the missed opportunity. I also had other real estate opportunities come up that I didn't have access to capital, and I passed on them, right? So it's not that the 401k performed poorly. It actually performed fairly decent, but it was the lack of control that caused me to miss a lot of other opportunities that came my way that would have been much, much better in the long run.
And I think one of the things about real estate is that it's for me the only asset that's going to give you inflation, like a pure inflation hedge from a long-term perspective. It's going to get you actual tax deductions, right? But through depreciation and other expenses that you have that go along with the property. And so when you combine those two, like a lot of people think that when you put money into a 401k, you're getting a deduction because you're able to deduct it off the income this year. If you make 100,000 and contribute 10,000 to your 401k, you think you get to deduct it. You're getting a deferral, not a deduction. And so, you know, like once again, it just goes back to that's not a good or bad thing, right? Because if you could get a deduction on your taxes back in 1980, when the marginal tax rate when they launched 401ks was top marginal tax rate at 70%, and you could maybe pay it 35%, 35, 40 years later. Well, that's a fantastic deal, right? Like, so it's not a good or bad thing. It's just, I always kind of tell people, what worked for your parents is not going to work for you, right? Like, and I say that because what worked for my parents is not going to work for me because the economic environment is completely different. They worked their entire careers, but I was born in 1980. So it's just like the perfect part of the cycle when it was at its peak. My mom was 19 years old when she had me. And from that point, interest rates went from 19% to 0%, and they had QE 1, 2, and 3, and they had COVID, all this stimulus and all these different things, right? And so like, there's just been so much monetary manipulation and lowering interest rates that have helped boom the economy. And now how you succeed in a decreasing and flat interest rate environment is completely different than how you succeed and what you need to do to make sure you're successful in an increasing interest rate environment. And so the problem is that people have been trained how to handle their personal finances according to the people that taught us, who it's not that they're well-intended, I think most of the time, people that are trying to teach us things based on, what worked for them, right? Because that's typically how things work, right? If you're an athlete, you're going to teach people how to do something and perform in your sport and, do a certain move or, throw a certain way or do a certain thing based on what worked for you, right? Like that, or based on your own knowledge in that arena. And people that are teaching this stuff, like Dave Ramsey, like I could make an argument that back then, okay, like there were some points to his argument because interest rates were really high, right? Like back in 1980, when a mortgage rate was 14, 15%, yeah, it's probably pretty stupid to have any kind of mortgage debt for as long as people wanted to have, right? And so like the story completely changes and the principles change when interest rates hit 3%. And where my critical lens comes through is I get really critical when people are not thinking critically, right? Like when people just kind of follow and they're just following this advice that's been done, and people are not asking why enough, and why has the economy, grown more since 1980, in this 45-year window than any other 45-year window in history, right? And if you look at it, the interest rates, that led to it, the tax rate environment, the fact that 401ks were actually created, all these different types of assets were created. A lot of people say 401ks are the traditional way of investing. I'm older than a 401k. A lot of people love Roth IRAs and they think they're this dependable asset. I was in high school when a Roth IRA was created. And so the verdict is out on what these strategies are actually going to do for people. But what there is no debate about is utilizing whole life insurance as a foundational asset and utilizing real estate as a wealth creation asset. And when you combine those two together, that's what we call cash flow hacking. And in my opinion, nothing can come close to it. And here's what I'll say. I can't help myself but go here, guys. I'm sorry. But this is why I love the whole life conversation and I hate the IUL conversation, the way that it's sold online, because of the fact that whole life is a savings alternative. And when we sell it right, not saying that everybody's doing it the right way, but when you do it the way that we talk about, you're talking about financial structure and the need for a savings alternative to be able to save capital and then invest in cash flow producing assets like real estate. So it's a savings alternative with a completely different strategy on the outside, to take advantage of these assets that are going to help you create wealth. Whereas an IUL is simply saying, let's shift money from a 401k into this product and have this company that's never had any success really getting good returns for anybody from a long-term perspective, that they're talking about. They've never really had any success. They're going to experiment here, and we're going to use a universal life chassis. And by the way, the only success that the only experience from a long-term perspective that they've had with a universal life chassis is actual universal life. That was the top selling product in the 80s and early 90s, and then ended up being a complete calamity, right? So that's what we're dealing with, right? And so it's just not the same conversation, right? It's a savings alternative compared to an investment alternative. And the challenge is when you go from, should I do a 401k and should I do an IUL? You're really not having the right conversation. You're coming at this from the perspective of, it's still a zero-sum game. You're still dealing with you're giving up control of your money, and you're there are so many variables on the table that you don't control. And when you put yourself in that position, there's an opportunity cost that comes to that, right, from a long-term perspective. And that's just the way I look at it. A lot of the positioning around how IUL is a better alternative to a 401k, I would argue that you need to eliminate the conversation of having an investment alternative at all, and you need to focus on saving and guarantees first, build your foundation, and then find the assets that are going to, give you all these benefits and create cash flow and all these things. And IULs are just not going to create cash flow. That's just my thing. And by the way, for that, I guess to that point, neither is whole life. Whole life is not going to create cash flow. How you handle whole life and what you will create with whole life will create cash flow. And a lot of people would argue IUL could create a lot of the same things, and you have liquidity, and although you don't have as much liquidity, and you have a lot of unnecessary risks and variables that come with IUL. And so it's just a function. Once again, I look at everything as what's the upside, what's the downside, can I live with the downside? And the answer is, if I can't live with the absolute worst case scenario in any product, I don't do it, period. If I can't look at any scenario and say, hey, I don't believe in it, I don't believe that's going to work, then if I think there's a relative degree that it's not going to work, I just won't do it, because there are plenty of opportunities out there that I can take advantage of. So let's see here. Brian just made a comment. 80s and 90s whole life also had their challenges, though. As interest rates came down, so did dividends. Oh yeah, so illustrations were not remotely close to performing as illustrated. He's not wrong, right? And so, but that's not the point.
You know what the difference is, Chris? You know what the difference is?
Go ahead.
Whole life policies don't lapse.
It's true.
Because of it.
That's true. And so
that's the difference.
100%.
I'm sorry, you can't compare the two. Yeah, you are correct. It did not perform as illustrated, and that is frustrating. Okay. Mm-hmm. But the client is not at risk of the policy lapsing because of it.
Right. right? And listen, at the end of the day, this is where and his argument right here goes to exactly what I was saying. In a decreasing interest rate environment, that is stressful, more stressful on the general fund of the life insurance company, because the bonds are buying and rolling over every year, getting cheaper and cheaper, and so the dividends have to come down to meet the fixed market. But whereas that was rough and illustrations underperformed, I would make the strong argument that I'm expecting, no guarantees obviously, but I'm expecting over the next 10 years that whole life illustrations are going to outperform what you're actually sold, right? Because of the fact that we're at this all-time low dividend rate for these insurance companies, and we have the guarantees, and then we have the current dividend assumption. And when you look at the illustration on a current dividend assumption, it's just saying, all right, we assume that the insurance company is going to pay a dividend every single year because they have every single year. And it's going to assume that it's at today's or this year's interest rate environment, right? Like the current dividend scale, right? And so if the current dividend scale is 5.25 with a company, it's saying, all right, this illustration on the current assumption is assuming that it's going to pay you a dividend every single year at 5.25 as the dividend scale, and that's it. And so, if the dividend rate goes up, which I fully expect it's going to in the market, then so there too is the performance of that policy, and the it's going to outperform the illustration. Whereas with IUL, we've already seen markets show that they don't perform as well as the interest rate environment, or as well as the illustrated expectations, even in the biggest bull run of all time, right? Like on a majority. Not to say that some of them haven't, not to say that it's impossible, because there are some outliers and some success stories. I still have yet to have anybody really step up and be willing to show me a successful policy face to face and win the challenge and actually do a debate live about it. I know Brian wants to debate, and I'll definitely, Brian, we're going to get to it here shortly, but it's ridiculous to me. Like the conversation is apples and oranges, and all these IUL agents are trying to make it seem like it's an apples to apples conversation.
Yeah, it's not even close. And real quick, like with the illustrations, the other thing that we can do on our illustrations for whole life is we could scale down the current dividend rate on the illustration if we want. So if dividend rates go to 7-8%, but we want to be conservative, we don't have to show the full dividend scale. I've never seen an IUL illustration that shows a down year ever. Right. So we can actually make the illustration much more conservative.
Yeah.
The IUL illustration is showing an up year every single year, plus that positive arbitrage when they start taking income. That's never going to happen. And if you show a zero, like multiple zeros on an IUL illustration, you won't sell it because people won't buy it at that point. They're not going to like what they see.
Yeah.
So
I love
apples and tater tots.
I love last week when we were talking about that topic, Brian was talking about how, that doesn't really have a negative impact because it's a double ledger system. And, like at the end of the day, though, you cannot take money out of a policy or you have to cover the fees and the expenses from somewhere. And when markets don't perform and credits are not credited to the policy, those costs are still getting paid. And at the end of the day, that's why these lapses happen. And so for him to say that this double ledger system magically solves that problem is just absolutely insane. And if that's what he's teaching, Brian, bro, our debate's going to get really, really heated.
Yeah, Chris, I think, a lot of what I notice with certain people it always goes back to, well, this return or that return. But, it's like when you build a house, do you build on sand or do you build on rock? Right. It's the foundation that matters. And
I really like the beach.
I get that. But the point is here, like it's just like a biblical principle, right? Like you build on a rock, it's a strong foundation, and your house is going to hold, versus you build it on a surface that's not so strong. You might have issues down the road. But one thing I've learned is there's two key words in financial literacy, and I think control and leverage. I hit on control earlier. And the whole life gives you that control, but the leverage, right? That's what makes these life insurance policies strong. And then, like I said, it's back to the real estate. What gives you more leverage? You put $1 in, the bank gives you $4, right? And then not only that, you start having other people pay off your mortgage on top of that. and you get massive leverage. And so it's just like changing the conversation. Because I think, you know, back to the government, you know, they implemented these plans, and it's like, hey, let's teach people to save or invest towards their retirement. And it's always been about, I believe, them controlling us. And so the conversation is never about cash flow, right?
Yeah.
And so if you can change that conversation, all of a sudden the whole strategy changes, and you think with a different mindset, and everything shifts, right? The answer is completely different. I remember hearing this: you ask different questions, you might just get different answers.
That's true.
Comes down to that.
You know, it's interesting, like, and this just happened, like, this just kind of popped in my mind, going back to what Brian was just saying. And it's just kind of funny to me. Like, I feel like I beat my head against a concrete wall sometimes. Like, I got a concrete wall over here, and I just kind of like want to go just smack my head against it a couple times, just be like, all right, is there something wrong with me? Because what I don't understand is how, like, somebody like Brian, and Brian, you're back. Okay, it's good. You're here to hear this. What I don't understand, and I really want to hear the answer. Like, Brian, I want you to prepare this for our debate. IUL's been around since 1997. Really has only been popularized, had any legitimate market share since 2009, where, you know, they took advantage of the Great Recession and so on and so forth. Since then, you know, we've had 3 regulation updates. You know, regulation AG 49, 49A, and 49B. You know, we've had a track record of these policies not performing well. I have yet to see somebody going a full cycle of funding a policy and then going through and taking income and actually seeing just one success case of somebody using this the way that everybody is selling it. And so the fact that there's anybody speaking about, I've got this figured out, I have figured out the problems, I know exactly how this is going to work, without having one success case. I don't know about you guys, but in anywhere else in life, that's just a scam. Like, it's like some dude being like, I weigh 300 pounds and I'm 150 pounds overweight or 100 pounds overweight, and I eat donuts every day for breakfast. But guess what? I know how you should get in shape. Like, I know how you can be healthy, right? Like, it's like, have you been, well, I was healthy once upon a time, you know, like, but like, I have, like, it's insane to me, like, that there's not one real long-term success example, and that these people that have been doing this business for 4 years, 3 years, 5 years, 6 years, like, whatever it is, they don't have one piece of fruit on the tree that they can speak to and show, yet somehow they convince people, you know, that somehow this is good, you know. And it's mind-numbing to me, like, and people fall for it, you know.
One thing that I've seen in conversing with people selling IUL, and I myself was in WFG, so I learned a lot of the talking points from the inside. And looking at it from my point of view now, and knowing what I know now, a lot of the arguments for IULs are made with statistics and singular data points. And when you think about, in contrast with the selling points for whole life is sold more on wisdom. Like, these things have been around for a long time doing what they do. When you talk about, Chris, when you talk about IULs being sold as, you know, when you say that how is a company selling an IUL going to get you a greater rate of return than they'll get themselves? Like, that's wisdom. And IULs are sold on singular, again, data points and rates of return and individual numbers, rather than taking a step back and looking at the situation as a whole and like, does this really make sense? Is this really, if you look at all the moving parts, do these products really make as much sense as something that's simple and reliable, like a whole life policy? That's one of the reasons why I'm so sold on whole life and believe in it so much.
I love that. That is a great point. And you said, I always say math and money are completely different, right? Like, you could make the math and have these points that kind of show IUL as being great because of the quote unquote math, but the money side of the math, and how money actually works inside of the IUL is completely different how the math shows, right? Like, and so that's that. So that's that. We just hit an hour. Anybody have anything else they want to like kind of like land the plane with? Take 30 seconds or a minute each to kind of like land the plane.
I think in the future, when whether it's a year or 2 years or 5 years, all the stuff that we're saying, we're going to look back and see like how we were right on the right track. And I'm just really excited in the direction that we're going. And I just can't wait till we get to that moment, because I'll just leave it at there because I don't want to go on a tangent.
All right. How about you, Michael?
Yeah, I just want to double down on what you said. Like, I'm also the very same way of, I get critical and people don't think critically. And if there's one thing I can encourage people to do, or just like think critically, right? Like, and don't just get so focused on one thing. Think big picture. Think about things from a long-term perspective. Don't make short-term decisions or long-term decisions on short-term thinking. And really just think critically. Think through things. We all get told, hey, this is what you should do. And a lot of times we just kind of follow the pack, right? Like people are like sheep in a lot of ways. And we got to just kind of stop that mentality, right? Just start to think for ourselves.
Yep. Absolutely. All right. Love it. All right, Matt, what do you think?
Yeah. So I guess what I would finish up with is, we've talked a lot about, different financial products today, and, things that are going on in the economy and around the world and stuff. And, one of the things I say on my channel is, at the end of the day, in order to make the best decisions for you and your family and your goals, your life, you have to understand how these different things work. You can't just blindly put your money into something just because that's what the mainstream media tells you to do. You have to, if you're going to if you actually care about your financial future of yourself, your family, you have to take responsibility for your financial education. There is a direct inverse relationship between how much money the banking system makes off of us and our financial education. The more we know, the more we understand about how these things work, the better choices we can make with our money, the less the less wealth the system is able to extract from us in the form of taxes, inflation, and all this stuff, right? So I would just encourage people to do your research on all of these different things. Figure out what is going to be best for you. First, make sure you have that really solid foundation, whether it's whole life or whether it's something else. It doesn't matter. Who am I to tell you not to do an IUL, even though I would never do it ever? But as long as you understand what you're putting your money into, then that's going to be best for you, right? But you have to understand it. So I would finish with a couple of book recommendations just based off our conversation today. Killing Sacred Cows by Garrett Gunderson, and then Pirates of Manhattan by Barry
James Dyke. Yep.
Yes, thank you.
Awesome.
That a great foundation for that.
Yep.
So that would be my 2 cents.
Love it. All right, Charles.
Yeah, just to piggyback off what Matt was saying, as far as the financial literacy, it's a generational thing. So if we want to change generations, if we want to really change the outlook of the future, put less money into the banking system, we have to start teaching our kids. But the way that we're going to teach our kids isn't by telling them. I mean, that's part of it, but it's really showing them. So being the example of how to utilize money in a responsible way. And don't be scared of that conversation. Talk with your kids, talk about building those foundations so that they understand once they go out into the world, they can actually make better decisions and be more responsible. And I think as a whole, it'll just make our society that much better, because there'll be so much less stress and people will just be that much better off.
Love it, man. Love it. All right. Mr. Kamke.
Yeah, I think for me, the final thoughts here are just, at some point the clock's ticking with the economy. At some point, we're probably going to be into a recession, right? I don't have a crystal ball, don't know when it's going to be. but where do you want to have a foundation? Do you want it in something that's going to be risky? Do you want it in something that's going to be stable? And, there's a lot of uncertainty probably coming. There's probably some downturns coming in the next few years, maybe after this election cycle's over, after the artificial propping up of the economy is no longer there. Something's going to happen. So where do we want to have our money? Do we want it to be in a stable place where they know how to manage that risk, or do we want it to be in other places where it's going to negatively affect us potentially for the next decade or more till we can rebound after that? So really for me, it's just knowing the inevitable is coming and making that decision on where do we want our bedrock to be.
Yep. That's awesome. All right. I'll give you one more last go. You have anything you want to finish with?
Oh yeah, I mean, all the points have been covered pretty well now. So I just want to say I'm really grateful to be having these conversations and to be a part of these conversations. I
Love it.
I don't hear the things that we're talking about. I just don't hear them being spoken of broadly in other places. So the more we can have these conversations, zooming out, looking at the big picture, focusing on wisdom and knowledge rather than individual data points and little bits of information, I think that's going to really help change the tide for our generation and really help to up-level people's financial literacy and help people make those more informed decisions.
Love it, man. Well, that's awesome. Well, guys, it was a fun convo. I think we covered a lot of really good stuff. I say let's keep the conversation going. Let's keep this up next Wednesday. We'll continue it. But thanks for being here. Anybody has any questions about anything, I will put the contact information for every one of the guys on the panel down below. If something they said resonated with you, connected with you, reach out to them. Use the link. They all have a social media presence, YouTube presence, whatever. So go down them, follow their channels, connect with them, all that fun stuff. And if you have any questions, you want to talk about your personal finances in any way, shape, or form, there is a link down in the description below on YouTube as well that you can go to. And if you're watching on another platform, which I know some of you are, you can just go over to check out the YouTube videos and we'll go from there. So, all right, have a blessed, inspirational day. We'll talk to y'all.